Hi everyone, this is the second part of the video series on the first time back trading strategy. In the first video we basically discussed the basis of a setup in terms of a supply demand FTB and an SR FTB, and what we look for in terms of the arc-like retrace and some basic logic as to why the first time back to a zone represents the highest probability of the same supply-demand imbalance that caused the initial breakout still existing, compared to price coming back, say, the second, third and fourth time, where each time price comes back to an ST zone, it is consuming supply-demand. Okay. In this video we're going to talk about some more advanced concepts in terms of the logic behind why an FTB works in terms of order flow dynamics, and we're going to build on the videos where I spoke about finding supply demand within SR zones and what supply demand caused the breakout of an SR zone, and then the other video that spoke about finding decision points within SD zones across multiple time frames. We're going to use those concepts in terms of establishing entries and deciding on stop loss placement. Okay. And lastly, we're going to talk about pairs, the difference between majors, crosses and exotics, and non-forex pairs, time frames I look at, and time of day, and the considerations around that. Okay. So firstly, this was a slide from the first video where we were talking about the basic logic behind the FTB setup, which I just spoke about in terms of price. Each time it hits a supply demand zone, it is consuming supply demand, and therefore it holds to reason that the first time price comes back to a supply demand zone, it has the highest probability of having that same supply demand imbalance again and being rejected away from a supply demand zone. And remember, when I'm talking about supply demand, that an SR level is just a cluster of supply demand zones at a similar price. Okay. Now, before we move on to the next step, which is order flow dynamics and some more advanced reasoning behind why an FTB setup works, I need to take a step back and think about mindset and how a professional trader thinks about things compared to a novice trader. Okay. So a professional trader, when he's looking to buy or sell, is always looking to buy from a novice trader or sell to a novice trader, okay, compared to buying or selling from another professional trader. Okay, so how can a professional trader know whether a novice is buying or selling a particular area? Okay, well, you have to consider, one, where is order flow concentration likely to be high? Okay, and for example, that could be support resistance areas, swing highs, swing lows. Okay, and how is a typical novice trader trading around these significant order flow concentration areas? Okay, so for example, if you want to consider a support resistance zone, who is buying when price breaks through a support resistance zone, who is selling when price comes back to a support resistance zone, and where are their stops likely to be clustered? Okay, and what you can do in terms of novice traders is you consider classes of market participants. Okay, so example, a breakout trader, okay, a trend trader, okay, a counter trend trader, okay, and because of the herd mentality in terms of how novice traders think collectively as a whole, you can pretty much estimate where stops are likely to be placed above swing highs, okay, above SR zones. Okay, so you can figure out where clusters of stops are placed and where clusters of certain types of orders are placed. Okay, and you can use that to your advantage because you know the effects of the order flow within these order concentrations, and you know how price will move there, and therefore you know where liquidity is likely to be concentrated. Okay, it's easier to discuss that with some examples. Okay, so we have some supply demand zones here, imbalance, out of balance, strong breakout. Okay, what happens when price moves above this support resistance zone here? Okay, sellers who have been selling and who are continuing to sell when price comes back up to this resistance have stop losses clustered above these swing high points. Okay, that's common sense. That's how most people will place their stops. So we know if these stops are hit, they are essentially buy orders. So we have a cluster of buy orders here. Okay, so what's that going to cause? That's going to cause a rush up in price. Okay. Okay, it's the same when price breaks below this support resistance. We have swing low points here within this. Stops, people that have been buying on the support have stops here below these swing low points. Okay, and because these are very well defined support areas here and resistance areas here, we're going to have a high order flow concentration. Okay, so when price hits these stops, okay, these stops from buy orders are going to be sell orders. Okay, the opposite of buying is selling, so this is going to cause a rush down. Okay, and you have to remember is in terms of why price moves to find liquidity. Okay, when these stops are hit here, price will move up to find supply. Okay, to find sell orders. Okay, if these cluster of buy orders are higher than the cluster of sell orders in terms of volume, then price will move up to the next price level, and it will keep moving until it finds sellers. Okay, and this is why we expect price to break out with a rush, like a high momentum rush, because we're always going to have a much higher order flow concentration in terms of buy orders here than sell orders. So all the sell orders get consumed and price has to keep moving up until it can find enough sell orders to match those buy orders. Okay, price always moves to find liquidity. Okay, and it moves because demand exceeds supply, or supply exceeds demand. So this is why I call it the breakout rush, and why we see a high momentum move when price has a breakout from a very clear support resistance area or above swing high, swing lows. You get the rush because the order flow concentration around that area is discussed. Okay, so if we move on this onto an actual first time back setup, we see we have the breakout rush. Sellers are selling at this resistance, price breaks through, therefore the stops, which are buy orders, are triggered. Price has the initial rush, it now starts to move away. So who's caught on the wrong side of the market? Sellers who have been continuously selling at this resistance. So you can say range traders, okay, but anyone who is continuously selling when price is hitting a resistance for the first, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10th, however you want to count it, multiple times. Whereas a professional trader, we know that the more times price hits a resistance, the weaker it is potentially becoming, because price is consuming the available supply at that resistance area. Therefore, it is very likely to get weaker, and we can see in this example we have a breakout pattern in itself in terms of weaker moves away from the resistance, which suggests that the resistance is getting weaker. So anyone caught on the wrong side of the market here is pretty much a novice trader, because no professional is going to be selling at this resistance given this pattern and given the number of touches of the resistance. So a novice trader is going to be caught on the wrong side of the market. Some of the stops will get triggered, and that's what causes a rush, but there will be sellers who will be holding on. Okay, novice traders don't tend to cut losses. They tend to move stops wider and tend to believe that price will come back and just trade in hope. Okay, so novice traders are going to be caught on the wrong side of the market here, and they're going to be looking to bail as soon as price comes back to near break even. Okay, so when price comes back here, what is the order flow concentration here, and who are the classes of market participants? Okay, well, sellers who were already short below the breakout level have been caught on the wrong side and sweating it out because price has been moving away against them continuously. Now it's starting to come back. They just want to get out. Okay, so a break-even result is considered a great result for a novice trader who's been caught on the wrong side of the market and seen price go strongly against them. Okay, they just want to get out. That's kind of the psychology behind, in terms of the mindset, in terms of if price goes far against you and it comes back and you see you've been thousands or whatever in drawdown and it comes back to near break even, you see that as an opportunity to get out, and having suffered a lot of pain, just get out as quickly as possible. Okay, and also the way a novice trader works is, as I said, in terms of losses, they don't tend to cut losses short. The opposite happens with winners, and as soon as price goes into a small profit, and doesn't continuously shoot in their favour, they tend to cut winners far too quickly. A novice trader generally has a profile in terms of their win rate is half decent, but their average loser is much higher than their average winner. Okay, so sellers who are short are looking to bail, okay, as close to break even as possible. Buyers who missed the initial breakout see this as an opportunity to get back in. This will be even more so if we have an underlying strong trend here, especially if it's a high time frame trend. Buyers will be seeing this as an opportunity to get into a trend at a discount, okay, compared to price being up here, okay. Sellers who sold from up here, obviously price has moved down, so there has to be some strong selling involved for price to move down. Sellers who sold when price started to move down are now in profit and will be targeting the support resistance as an area to take profit, okay. Anyone who sold here will clearly see this support resistance, any technical trader, and will see that as an opportunity to take profit, okay. So that's in terms of who is participating. Next you need to think about what type of order flow do they represent, okay. Sellers who were short and are caught on the wrong side of the market are going to be buying. They'll be taking profit and therefore they're going to be buying, okay. Buyers who missed the initial breakout are going to be buying, obviously. Sellers who are in profit and looking to take profit are going to be buying, okay. And also, lastly, buyers who bought on the breakout and were involved in this breakout rush, as well as the seller stop losses that got triggered, will also most likely have set break-evens, okay, moving stop loss to break-even, etc. That is a very common practice, rightly or wrongly, amongst traders, and thus there will be a series of break-even type orders here from buy orders, and therefore that's a sell order, okay. If you're buying here and you've set up your stop loss to break-even, the opposite of buying is selling, and therefore there will be some sell orders clustered within this range as buyers have started, breakout traders are starting to get involved, okay. But so you can see the main market participants that we know are going to be participating at this area are buying, okay. You've essentially got a 3-to-1 ratio here. Okay, that doesn't mean there's going to be every sell order is going to be three buy orders. It's certainly not the case, but the vast majority of market participants participating at this area have buy orders. Okay, so the order flow concentration are buy orders, okay, and that is pretty much an advanced order flow based reasoning why the FTB setup works. Now the last thing to look at is what happens in this space here, okay? Because what we will typically see when price approaches the SR, that's the basis of our FTB entry, is price will move down with good momentum into that, okay? It will have the opposite of the rush that caused the initial breakout back into this area, okay? Now it's important to understand that's something we want to look for, and obviously the confidence that leads to appreciating that's something we want to look for is understanding why that might be the case, okay? There's more than one reason. The first one is the break-even orders I mentioned before from the breakout traders here who've got involved in this area here, and they've set their stop loss to break even. That is going to cause a cluster of sell orders down in this area, okay? Another reason is when price broke above this area, it flushed out all the orders. Okay, there was a cluster of sell orders, either stop losses from sellers, a cluster of buy orders, the stop losses from sellers, and that order, because price moves with good momentum, it flushes out the order flow concentration within this area. Therefore, we have a liquidity vacuum of sorts. Okay, it's not a pure liquidity vacuum, but potentially we have a partial liquidity vacuum. And what does that mean? That means the order flow concentration within this area is very light, and therefore price moves through it very easily to find liquidity. Okay, if you remember, price is always moving to find liquidity. Okay, if there is no buy orders within this area, but there is sell orders, then price will move down very quickly until it can find buy orders. Okay. And the last potential reason, which probably won't be the case too much in this on this one, but sometimes you'll see a support level form not far above the main FTB support level. And obviously if this area, if there's a strong support area here and price breaks below it, you're going to have the same breakout rush which happens here, but in the opposite direction. Okay, so it's important to remember that we do expect a good momentum move into our FTB area. Okay, and because of the order flow concentration here, we expect a strong move away. Okay, so it's not typically, novice trader will be scared of price moving fast against them. Okay, but it's important to realize it's not something to be scared of, and it's something to embrace and something we fully expect, and I've explained why. Okay, and I'm not talking about price moving 100 miles an hour from up here. I'm talking about price moving fast as it gets very close to our FTB entry area. Okay, and I've got some examples of this. First of all, just a summary. It's just a summary of what I said. So go back where we are so far in terms of video 1 and where we are with video 2 so far. We have a significant supply-demand imbalance, i.e. a strong breakout, a strong clear breakout. We have space between that breakout and first return, the arc. We then expect with high probability price move with good momentum when it gets close to our SDSR zone, and then good momentum away in terms of reaction away from our SDSR zone. Okay, and I explained the order flow dynamics as to why this works in terms of market participants and the order flows they represent. Okay, and that's not the only way you can use that kind of knowledge in terms of market participants and order flow concentration. It's something to, it's a kind of a mindset thing in terms of thinking who is participating, what order flow do they represent, how does that suggest price will move, how is a professional going to take advantage of the knowledge in terms of, when I talk about a professional, I'm talking about an institution player who can move the market. How are they going to take advantage of the order flow concentration that they know is very likely there? Okay, that can be used in more strategies than just the FTB strategy. Okay, so examples of FTBs are more focused on the good momentum move into our FTB and then momentum move away. Okay, see here, this is a clear SR, this is silver. The arc, price comes back, and you see it moves down very quickly, and on the same bar reverses very quickly. Okay, this one's pound yen, another SR FTB, very clear SR, price comes back, and you see as soon as it moves again above this clear resistance, we have that order flow concentration, we have buyers causing the rush, but then as you can see, price is instantly reversed. Okay, next one, this is Kiwi dollar, and this is a rally-based rally FTB, an SD zone FTB, and again you can see price is moving down fairly slowly, chopping around, but as soon as we get close, you can see that when we break from up here, and then when we break this area here, price moves with very good momentum, and again it is instantly reversed. Last example, this is rally-based drop, this is euro pound, clear SD zone, clear strong breakout, arc-like return, and again you can see when price moves above this base that has formed, we have a very strong move in and a very strong move away. Okay, so hopefully that will give you confidence to not get scared when price is moving with good momentum into our FTB area. Okay, because it's exactly what we look for. It doesn't mean we get it every single time, and doesn't mean if it doesn't happen we shouldn't be in a trade. Okay, but this is what we typically expect from an FTB setup. Okay, in terms of how price moves when it gets close to the area and how price gets rejected. Okay, and as I said, it doesn't mean price will always do this. Sometimes it will hang around for a while before getting rejected. Okay, it won't always happen in the same ways, but more often than not, this is how an FTB setup works. Okay, and how it will look when you look over your charts. Okay, so something just to bear in mind. Okay, what I'm going to do now is look at entries and stops. I'm going to use those same 4 examples in a minute, but just to go over the basis of how we find entries and stops. And again, this is discussed. This is using concepts I've already been over in my other videos, which I mentioned at the start of this video, okay, in terms of finding supply demand within support resistance zones, and then finding decision points using multi-time frame analysis within supply demand zone themselves, okay. So basically our entries are going to go at the first possible decision point where price is likely to find supply demand on the retrace, okay. Stops are going to go beyond a logical decision point or source of the initial supply demand, okay. If it's an SR zone, it's more likely to be the source. If it's a supply demand zone with substance, it's more likely to be a decision point rather than the source. We have to always bear in mind with an FTB setup that we don't expect price to make deep retracements beyond an SR zone or deep retracements beyond an SD into an SD zone, okay, on the FTB. Because it's the FTB, we expect a quick rejection, okay, and it to reject price strongly and pretty much near where our entry is, okay. We don't expect a deep move into a substantial SD zone on the FTB, okay, because we expect that supply demand imbalance to be still very strong. Okay, so we use that to our advantage when placing stops. We place stops beyond logical decision points and not necessarily be far below the edge of the zone in terms of the source of the initial supply demand. Okay, and stops are always placed with long-term expectancy in mind and not win rate. Okay, a typical mistake a novice trader will make is they will look at swing lows, swing highs in terms of where placing stops with compared to looking at supply demand that caused the initial breakout and looking at that to hold on the retrace. They just look at wide-ish swing lows, swing highs or SRs and place stops 30, 40, 50 pips on a dollar major pair, and they are more focused on having winning trades than long-term expectancy. Long-term expectancy is a function of trade frequency, risk reward, average risk reward, and win rate. But novice traders generally more focus on win rate than the other two, and that has a detrimental effect on your long-term profit. A professional trader, and myself included, only ever care about long-term expectancy and maximizing long-term account growth, okay, i.e. long-term profit. Win rate is only a function of confidence, but I don't care if win rate is 90% or 60%. I would do whatever will bring a long-term high expectancy, okay. Okay then, so I'm going to look at the first one, which is silver. I'm going to move fairly quickly over these. I appreciate this video is going to be quite a long video, but I'm going to move fairly quickly over these because I've already been over these concepts before. But I've deliberately chosen examples which probably aren't the easiest ones you'll find in terms of determining stops. Okay, entries should be pretty straightforward, but stop losses are where the difference is made in terms of risk reward, and generally the harder thing to look at. Okay, so it's an SR FTB. This is 1 hour time frame, 1 hour setup. So now I'm going to zoom in to find decision points. Okay, so I'm going to go down to 15-minute time frame. Now, first of all, we can tell that this is the source. This is the source that led to the breakout. Okay, but this source is far away from the support resistance zone. My stop loss is never ever going to go below here because I do not expect a move down through this SR down to here and then a rejection. Okay, and even if I did, then I'm not trading the SR. I'm trading this SR here. Therefore, I expect a reaction within the close vicinity of this SR. On this pair, a move down this far is not trading that SR. Okay, if you're saying, well, price could bounce here, well, it could, but it could also bounce here, move up to here, act as resistance now, and then move down here. But I'm not going to base my stop loss on the fact that price might move down here. Okay, I know that for a good FTB setup, price should not move materially or significantly beyond this SR. Okay, and certainly not on a pair like this in terms of average volatility of this pair, not this far beyond the SR. Okay, this SD zone is a separate setup maybe in itself, but it's not a reason to be placing your stop loss below here. Okay, all you're doing here is slightly increasing your chances of winning trade, and I say only slightly because I know that price shouldn't really go beyond the close vicinity of this SR, and most of the time it won't. So therefore, the times it does and holds this area and then moves back significantly above this area is going to be very low. Okay, so you're slightly increasing your chances of winning trade, but you're drastically reducing your risk reward, and therefore you're drastically reducing your long-term profit potential, i.e. long-term expectancy. Okay, so straight away when I look at this, I'll say, well, that's the source. Okay, but my stop loss isn't going to go below there, but that's the source. Okay, now we can see here that we've got an SR flip zone here, and we've got one here. Okay, so they are decision points. So I want to zoom in further. If we go down to M5, we can see that when price had the breakout, it came back and it tested this area here. Okay, so this is a definite decision point, and it was previous resistance here, and it's been an SR flip zone, and we can still clearly see this SR flip zone here, so that's another decision point. If we look at M1, pretty choppy, but we can see the clear decision point here, and then we can still see this SR flip zone, and we can see the source here. So my stop loss, the options are to put it below here, but the problem is if you put it below here, this has already been tested, therefore some demand out of here has been consumed. So it is logical to think that maybe all the demand out of here has been consumed, so price quite feasibly might move down to here before bouncing. Of course it might not, it might still stay up here, but it could act at one of those 3 points. I don't expect price to move below here. Okay, and I don't expect it to move down below towards the source. So my stop loss is going to be placed below 33.10. I always use a slight buffer because nothing turns on a pinpoint. So it's going to be a few pips below, say 6, 7. Okay. And where's my entry? It's the first possible place price should meet demand or could meet demand. Okay, so it's going to be above this decision point here. Okay, or this one here. This one's slightly higher. This one's more recent, but I'm going to put it above here. Again, I use a little buffer, and obviously you've got add spread on a buy order. So it's going to be, let's say, 33 plus spread. Okay, and my stop loss is going to be, say, 07s. Okay, and as we know, price reacted exactly at the first place it could and moved away. I'm not going to talk about target or exit, that's beyond the scope of this video. Okay, so that's silver. Next one, let's look at euro pound. So H4 setup, ignore the lines at the moment, it'll become clear when I zoom in. H4 rally base drop, or if you consider the large time scale drop base drop, doesn't really matter. It's just a supply demand zone FTB setup. So I'm going to zoom in. Now this one I remember being a little trickier. Yeah, the reason why this one's tricky is because there's no obvious clear edge to the zone. Okay, and why by clear edge I mean if you look at, say, the top edge, that's much clearer because you've got multiple touches of what is essentially a resistance which forms the edge of the supply demand zone. Okay, with the bottom edge we don't have that. We have a kind of support area there, but then more recently we have a drop down to actually find this demand here, and then we have a higher drop, and then we have a drop and some swing low points here. So it's not clear, so therefore it doesn't make it easy for established entries. Okay, so if I zoom into M5, I can't go into M1 this far back in the past. No. Okay, so we have this line here, this decision point here, we have this area here with this low here, we have all these lows here. I'm going to kind of ignore all these odd one lows here because it's very, very choppy, and this was a main swing low here in terms of how price reacted to it. Okay, these are all very choppy and not well defined, but what I do notice here is we have a drop, base, drop. Okay, this in itself is a drop, base, drop, which led to the strong move down. Okay, this is the source, obviously. Should be pretty clear to see. This is the source of the move. Price moved away strongly from there. Obviously, I don't expect price to get back to there on the FTB. In determining entry, now you could easily say, and it's not wrong to say this, my entry is going to go below here. But I'm looking at this, and I looked at this for quite a while, and I thought, well, price clearly found supply here, and this was what led to the strong move down. Okay, we had a move down, price moved back up, it found supply here. We know that this is a decision area here, and we can see here slight resistance here and support here. So I'm kind of thinking, well, my entry is most likely to go here. Okay, it's not wrong to put it there, but I think price has a higher chance of actually finding supply here rather than here, which is more of a minor decision point. Okay, but my stop loss is going to go above this drop-based drop. Okay, I don't expect price to move materially into here. Again, I'm going to use a, you've got to use a buffer. You can see all these wicks here that price, this wick here, these ones here, that price might move materially, not materially, but you can see how far price might move beyond an SR while still holding it. Okay, so our stop loss is going to probably be placed around 30s plus spread. My entry is going to be around, say, 22 or 21.5 euro pound. So you need to consider pip movements. 1 pip means quite a lot on a euro pound. Okay, so where did price go to the M30? So we can see when price actually reacted to. We can actually see that it actually did react at the top of that drop-based drop. Okay, so my entry would have been around 22s to 21.5s, for example, and my stop, as I said, would be at sort of 30s plus spread, I think I said, but above that drop-based drop with a buffer. Okay, and as you can see, price did as expected. It didn't go beyond there, but it did act right at the top of it and then moved away. Okay. Next one, pound yen. Okay, so this was a H1 SR FTB. We can see it here, very clear. So if we zoom in, M30, we can see we've got a decision point here. Price had to break here to move lower, but the most recent decision point was clearly here. And we can also see the source of the drop was most likely around here. We see it's a clear SR, and we can see we have a clear SR flip zone around here too. So move down to M15. Clearly see that the source was up here now, and we can clearly see this is a decision point and here as well. M5. Now we can clearly see this support area, which met support here as well. It's more of a zone. I've marked it up as the source again is clear. We can see price hit the top of this one here, added to support. Scrolling back, you can see resistance. It's kind of a choppy little zone here. Now the hardest thing here is, where am I going to put my entry? Is it going to be below here, or is it going to be below here? There's no necessarily wrong reason or right reason for this. The most recent decision point is going to be more important to me than one in the past. But I'm going to bear in mind that price could, and it does, do this in terms of it does treat the past one and react here. I've had times when I've put my order here, for example, and price is actually below here and you miss out. So it comes down to user preference essentially. I'm more often going to place it above the more recent one, below, or kind of midpoint between the two in terms of, I always use a buffer. So I'm going to say, well, I expect it's more likely to hit this one, but I'm going to put a buffer anyway. I'll put probably a bit more of a generous buffer to consider it might just go slightly beyond here and not quite reach the edge of this zone. Okay, just scrolling to M1. M1, we can clearly see the decision point here. We can clearly see, more importantly, this SR or supply demand flip here, and especially here. See the source here, price had to come over beyond here, so I don't expect price to move beyond this area. So my stop is going to go just above the the edge of this zone, so say 76, 77 plus spread. My entry is going to go, I'm going to put a generous buffer below here, say 59s, 59 or 60. And you see, where did price react? If we zoom in, can't remember, let me have a look. You see, first off, price reacted at the lower one, so if you were at the lower one you would have got in, but then it did react pretty much to the pip at the higher one, so either one would have worked out. You just would have had a slightly increased stop loss size, and then obviously it moved away quite substantially on this one. Okay, lastly, This hopefully should be becoming very clear in terms of the process to go through. Kiwi dollar, 1 hour, rally base rally, FTB. Let's zoom in. Let's go straight down. See, straight away when I mark up a zone, I'm going to put my zone below here and above here. Now I'm zooming in to refine it because I know my stop loss is never going to be placed below here, because that's way beyond the kind of the edge of this zone, and as I said, I don't expect a deep retracement. Now this one definitely was tricky because the zone was caused, the breakout was caused through a news-based move. So if we go down to M5, so you can't see any of this on H1, you can see this was a news-based move. Price doesn't move like this normally on this pair. This was a news-based move, and you can see it's created some very choppy price action. But straight away you can see the edge of the zone, this resistance or this high, and price tested it on the immediate retrace on M5 before moving away. So this is the first possible place price could find demand on the retrace. Now in terms of marking up decision points, this is clearly the source, but this is kind of a whipsaw low liquidity move. So I don't expect price to move anywhere near down here, but we can see we have a major decision point here. Okay, we're going to M1, and this one takes a lot of looking at, but you can see we have a resistance area along here, and we can see it found support here, resistance, support there, resistance, and then we had the quick move down to this decision point, break out, come back again, low liquidity, create a spike, and move up again. And we can see we tested, we got rejected, price rejected here, here, and here within this zone here. And then lastly, we've got a clear resistance here. Okay, so I would mark this as one big decision point zone. Okay, and my stop loss is going to go below it. Okay, this is where my entry is going to be based on. It's going to be just above here with a buffer plus spread, and my stop loss is going to go below this area. A little bit of a buffer again, say 31s, 30s maybe. Probably more likely to be 31s. And my entry is going to go, say, 40, 44s plus spread. And as you can see, price actually on this one moved into that decision zone, and again our stop loss below there would have kept us safe. But you can see how using tight stops but logical stops really maximizes your risk reward. Price might come 2-3 pips within your stop loss, but as long as you're maximizing your long-term expectancy through maximizing your risk reward, that's the most efficient way of trading FTBs. Okay, now I would see people place stops below here. That's just completely illogical. Price has such a low chance hitting there. Now it does happen, price might come down here and move away, but it's such a low chance of that happening and a low occurrence of that happening that it doesn't make sense to do it over the long term, because for every trade that it does that, you've probably got, say, 5% chance of it doing that, hitting there and then moving away and going to your target. So if that's a 5% chance of doing that, why do you want to be placing your stop loss when it's only a 5% chance of doing that, where the other 95% of winning trades is going to, stop loss below here is going to be sufficient. Okay, don't be affected by your win rate. Focus on maximizing your risk reward, which in turn maximizes your long-term profit potential and long-term expectancy. Okay, just wrapping up now. So the last thing I wanted to talk about was pairs, timeframes, and time of day. Now, I would trade any pair within reason, and any asset class within reason, but you've got to consider two things. You've got to consider liquidity, and you've got to consider spread. Okay, if I'm trading M5 on something exotic, say, I don't know, dollar versus Mexican peso, or for example, I don't know, some exotic pair where the spread is quite high. When I'm trading M5 time frame, it's not going to make sense from a spread perspective, because the spread is going to be so high relative to your stop loss absolute size. Say you've got a stop loss of 10 pips and the spread's, say 7 pips. That doesn't make sense because your cost of trade is so high from a percentage perspective. Okay. The other thing to consider is liquidity. The more exotic a pair, the less liquid it is, because the less people are trading it directly. Okay. Cross pairs and exotic pairs have their order flow resulting from direct order placement, i.e. euro into CAD, but also from their from their individual elements. Okay, so euro dollar, Canadian dollar, FX, euro CAD. Okay, so you have to bear that in mind in terms of liquidity, and you can easily see that on the chart. If I scroll into M1 on euro Mexican peso, it's going to be a complete mess. It's going to be unreadable compared to M1 on euro dollar. Okay, because liquidity isn't there. So you get less liquidity means less order flow concentration. Therefore, the order flow reasoning behind an FTB has a lower chance to work it out, and also you're more likely to get spikes. Okay, so you're going to get whipsaws and spikes, and you're more likely to get stopped out because price isn't going to turn exactly where you expect it to. Okay, so you've always got to consider liquidity and spread. Spread is a cost of trade, and that determines whether I'm going to trade a pair and also what time frame. So I'm more likely to consider higher time frames on less liquid pairs and a mixture of higher and lower time frames on more liquid pairs. Now I do trade exotics, I do trade crosses. I'm just more picky because of the liquidity and because I can look at higher time frames because of spread and liquidity. Therefore, I'm more likely to be more picky because I've only got a smaller sample of time frames to look over than on the majors. Okay. And I'm also going to be more cautious in terms of stops compared to on a dollar, say euro dollar, compared to a euro sec, for example, because of what I said in terms of liquidity. If price doesn't have much liquidity, it means it's going to drop. It's going to have whipsaws. It's going to have spikes to find liquidity because there is no order flow concentration at a certain price level. Okay, so you've got to be more cautious on stops when you talk about crosses and exotics. Okay, than the dollar and yen majors. Okay, so same with any other asset class. I would trade any other asset class because the order flow, because the order flow dynamics behind an FTB setup is transferable to any asset class. Okay, but you just got to look at how liquid it is and look at things like spread. Okay. Now, in terms of when am I going to trade or when am I not going to trade, we've talked about liquidity, and that also transfers to trading sessions. Okay. The London trading session has the highest volume of forex transactions in the market. Okay, Asia has the lowest. Okay, New York is in between. Okay, I would trade any active trading session, but I'm going to be slightly more cautious over Asia. But I still do trade setups during Asia. But I'm going to be a lot more cautious at times for twin sessions, especially between New York close and Asia open. Okay. You think who actively trades between New York close? I mean, New York afternoon session is normally quite slow anyway, but between New York close and Asia open, who trades then? Algos, no one really actively trades then. So you think, well, there's going to be a lack of liquidity. If there's a lack of liquidity, there's the lack of the order flow concentration, the order flow dynamics that we want occurring. Therefore, I'm not going to take a trade, or very rarely am I going to take a trade that's going to trigger during that market session, okay, or during the gap between sessions, okay. Another thing, I don't trade Sunday open. My start of weeks is London open. Okay, liquidity is very low during the first Asian trading session of the week. Okay, and the last one is late on Friday. Okay, traders pack up on Friday. You don't go opening an FTB trade at 8 p.m. British summer time on a Friday. Okay, because liquidity is going to be low on the last trading session of the week. Okay. So it's just, you've got to use your common sense in terms of liquidity, okay, in terms of when to trade, what time frames to trade, and consider the spread as a cost to trade, okay. Okay, I appreciate that's been a particularly long video and I've covered a lot of things in there. There's going to be one more video and then maybe a webinar, or maybe the last one will be a webinar, I'm not sure yet. But the next things we need to go over is exits, okay, in terms of trade management. That's more of a general topic as well, but we need, how do we decide FLR, FLSs, and how to exit, how to hold a trade beyond the FLR, FLS. Going to look at lots of examples. That's probably where a webinar might be handy. And I also want to go over some objective considerations, okay, in terms of trading near news times, impulsive moves, okay, how price behaves when when it's triggered a trade, in terms of if we don't get that liquidity spike, essentially what it is, you know, the quick move in, momentum into the air and reversal. If it doesn't have that, if it starts basing but within you know, your supply demand or SR area, is that a reason to cut a trade? Things like that is what I want to go over. Reasons to not take a trade, reasons to hold on to trade, reasons to maybe reduce exposure in a trade. Okay.